Paramount Plus will officially merge with Showtime on June 27th, and subscribers can expect a price hike. The combo was announced earlier this year. Showtime customers will get to watch Paramount content and vice versa. The price for the ad-free plan will go up by $2 to $11.99 a month. If you don't want Showtime, you'll pay $5.99 a month, $1 more than the current price. And meantime, Warner Brothers Discovery launching its Max streaming service today, combining HBO Max with Discovery Plus. Joining us now is Rich Greenfield, LightShed Partners co-founder. Rich, great to have you with us. You got all these combinations. You got a multitude of streaming services now. Does this all just show you that Netflix is the leader, is out in front, has the lead?
Look, I think what you're seeing is everyone is recognizing that they need more time spent. That is the challenge of all of these services, right? You need time spent for two main reasons. One, if you're not watching something on a regular basis, you're far more likely to churn off, meaning cancel and then re-sign up later on. Also, if you want to raise price and actually make money, because a lot of these services were priced pretty inexpensively. So if you want to raise price, you need people that are so engaged they can't live without these services. They're using them every day. But a lot of these companies are struggling. A lot of these big media companies are struggling to spend the type of money that Netflix has spent. And so what are they doing? They're aggregating services. Disney's trying to, combine with Hulu. You're seeing Paramount and Showtime, as you just mentioned, Melissa. Obviously, Discovery Plus is now being pushed into HBO Max. So more and more of these services are aggregating because they're trying to drive and solve for time spent, which is especially important as all of these services are now pushing their advertising tiers. So a little bit cheaper comes with ads, but ads only actually make money for you if you spend a lot of time watching ads. And so you really need to center on watch time. That's what Netflix has been focused on for many, many years. And I think now you're seeing from all of the major media companies out there why Netflix has been so successful is that they dominate with 2.5 hours every single day of watch time.
They dominate with their content spend. I mean, it seems, Rich, that one could make the argument that they're solving for time spent, but they're solving for money not spent because they want the growth in hours on their platforms, but they don't want to spend the money for the content. Is that going to work out?
Melissa, I could not have said it better. It is very hard to see, you're looking at, Disney's kicking content off of its platform. Obviously, Warner Brothers already did that. They're trying to fix that now by, putting in some of the Discovery content. I think, I think what you're really seeing is all of the legacy media companies are scaling back their ambitions. I mean, I think if I was sitting discussing this with you 2 years ago, everyone was chasing Netflix. They wanted to be Netflix. I think what you're seeing now, and I think David Zaslav at Warner Brothers Discovery, now the Max service, they're really scaling back their ambitions. They want to have a streaming service, but their North Star is no longer Netflix. They're going to sell content to Netflix. Like just over in the UK, I saw yesterday morning, all of the Harry Potter series. So that's a Warner Brothers series. The Harry Potter series is dominating Netflix over in the UK. So it's not just about licensing to yourself, which was really the story of the last few years. They're taking a very balanced approach. I don't want to say giving up, but they are certainly they are no longer chasing Netflix. And I think that's whether you're talking Warner Brothers Discovery, whether you're talking Disney, even Paramount. None of these companies are chasing Netflix the way they were 2 to 3 years ago. It's clearly helping their overall financial story at WBD. It's, the balance sheet is improving, pretty dramatically in 2023, but it's obviously also giving a big boost to Netflix investors because I think people essentially we believe they've won.
Right. If you are a legacy media company, though, and you were pursuing streaming because that was going to be your new growth engine going forward, and that's no longer the case, Rich, then what is?
Look, all of these legacy media companies have had a very long history of selling content to third parties. That's how they made tons of money for decades. They all got sort of excited by the early, if you look at the early momentum of Disney Plus, which came out of the gate with 10 million subs on day one. You look at the incredible success of Netflix over the last decade. I think they all got excited that they could do that too. And that it was, I don't want to say easy, but it could be replicated. And I think now you're seeing, hey, this is much, much harder. This is not as easy as it looks. we're going to take a more balanced hybrid approach of we'll have a streaming service, but we're not going to have the world's largest streaming service. We're okay to be a smaller but profitable streaming service. That's, I mean, I think you heard that first from Zaslav. And now in the last couple of weeks, you've heard it pretty clearly from Disney's Bob Iger. Like, they are just not going to chase the way they were. They're going to have smaller ambitions. Obviously, it's impacting the stocks. I mean, I think certainly that growth engine that you sort of referenced, Melissa, is not going to be the same growth engine. But on the other hand, the profitability is going to be far better. And I just don't think they had the balance sheets to attack Netflix, knowing that their legacy cable network broadcast TV businesses do not have the sort of stability that they had hoped for. Those businesses with cord cutting, the shift of ad dollars, those businesses are challenged. And I think they're making the appropriate sort of adult decision to focus on their financial outlook and not really risk stretching the balance sheet beyond what is possible.